So, have you ever applied for a loan thinking your steady, full-time job would make it a breeze, only to get totally bogged down in paperwork and confusing rules? Yeah, you are not alone. Today, we're going to dive deep into that income maze and untangle the surprisingly tricky ways different banks verify your salary. Let's get into it. You've got a good job, a regular paycheck, a solid payslip. That should be your golden ticket for a loan, right? Well, you might want to think again. The road from that payslip to getting your loan approved, it's often a winding one, and every lender is a gatekeeper with their own unique rulebook. And this, right here, is where it all gets so confusing. We're going to see that among the big lenders, there is no single standard. Nope. They differ on everything from how long you need to have been in your job, to how old your payslips can be, and even the nitty-gritty of how they do the final math. So let's break down these inconsistencies. All right, first up, your job history. How long is long enough? You'd think there'd be a standard answer to that, but as you're about to see, the timelines are kind of all over the map. I mean, just look at this contrast. It's wild. On one hand, you've got Westpac, who, for a non-insured loan, might say sure if you've basically just started and have a single payslip to show for it. But then on the complete other end of the spectrum, you've got a lender like FirstMac, who's going to demand at least 6 months with your current employer, or even a full year in the same industry. And then there's what I like to call the 3-month club. Lenders like ANZ want to see a clear 3 months on the job. For them, it's all about stability. It lowers their risk. But what's really interesting is how a bank's own rules can change. Notice how Westpac's flexibility just vanishes when you're looking at an insured loan? Suddenly, they join the 3-month club too. It just goes to show you, the type of loan you want can completely change the game, even with the same bank. Okay, so let's say you've passed the time on the job test. Great, now you have to prove it. And welcome to the paper trail puzzle, where getting the right documents with the right dates is absolutely everything. Before we get into the nitty-gritty, let's quickly clear up a key term you'll see all the time on your payslip and in bank policies, YTD. It just means year to date. It's the running total of everything you've earned so far in the financial year, and believe me, some lenders pay very close attention to this number. Now, generally speaking, most lenders are going to ask for some combination of these. 1 or 2 recent payslips, that's standard. Bank statements showing your salary hitting your account, also very common. And hey, if you just started a new job, sometimes your employment contract will do the trick. Pretty simple, right? Well, not so fast. Because while the types of documents might be standard, the real devil is in the details. It's not just about what you provide, it's about when you provide it and what specific information it absolutely has to show. And these details are so critical. Just look at the range here. BankWest gives you a pretty generous 60-day window for your payslip. But then you have FirstMac, who wants it fresh. We're talking less than 4 weeks old. NAB lands right in the middle with a 45-day rule. And remember that year-to-date figure we just talked about? See how it comes into play with ANZ? For them, your payslip must show a YTD figure covering at least 3 months of earnings. It is a total minefield of dates and details. Okay, and now for the final piece of the puzzle, the math. Once the bank has all your documents, how do they actually crunch the numbers to decide what you can borrow? You probably guessed it. There is no single formula. So the basic method pretty much everyone uses is called annualizing. It's simple, really. They take your gross pay from a single pay period and just multiply it out to get a yearly figure. Your weekly pay gets multiplied by 52, fortnightly by 26, you get the idea. This gives them a baseline annual income. But what happens if your pay isn't exactly the same every single time? And this is where the banks almost always play it safe. Just take this rule directly from BankWest's policy. If your salary payments fluctuate by more than 10%, they don't average it. They use your lowest payment to calculate your income. And BankWest is not alone here. This is a clear trend. NAB has a very similar rule for any varying account credits. Westpac will use your lowest base pay and your lowest hours. The message is pretty loud and clear. If your income isn't perfectly consistent, lenders are almost always going to use the most conservative number, and that could really lower the amount you're able to borrow. So, with all these different rules flying around, how in the world are you supposed to keep it all straight? Well, we've put together a little cheat sheet to help you see all the key differences at a glance. Okay, let's break this down, because this is where the rubber meets the road. If you've just started a new job, your most flexible options for timing are going to be NAB or Westpac. But look at FirstMac. They're going to want 6 months in the role or a whole year in the industry, so they're probably out. Now look at the document rules. BankWest and ANZ give you that nice 60-day window for an older payslip, which is really handy. But First Mac is super strict, demanding a payslip that's less than a month old. And finally, that math. If your pay tends to fluctuate, you gotta be mindful that BankWest, NAB, and Westpac will all default to your lowest figure, and that can really reduce your borrowing power. This table just shows how your specific situation can make one lender a total green light and another a complete dead end.
And that is the real power of this information. It's not just about trying to navigate the maze, it's about choosing the right path from the very start. Understanding these little details helps you pick a lender whose rules actually align with your life, and that can save you so much time, stress, and the headache of a potential rejection. It's all about working smarter, not harder.
So it really leaves us with a big question, doesn't it? Are all these different, complicated rules actually necessary to protect the lenders, or do they just create an unfair system that ends up penalizing perfectly good borrowers who just don't happen to fit into a neat little box? It's definitely something to think about.